happens if Bitcoin drops 50%? That's the real risk people need to understand. Let's walk through the math. The last video, we talked about borrowing against Bitcoin instead of selling it. Platforms like Coinbase allow you to use Bitcoin as collateral for a loan. You keep your Bitcoin, but you gain access to capital. Let's start with an example. You own $100,000 worth of Bitcoin. You borrow $30,000 against it. That gives you $30,000 in cash. Your LTV ratio is 30%. Now imagine Bitcoin drops 50% to $50,000. Your loan hasn't changed. You still owe $30,000. So now your LTV jumps from 30 to 60%. Most lending platforms have liquidation thresholds. If your loan to value gets too high, they may sell your Bitcoin to repay the loan. And that usually happens during the worst part of a market crash. This is why conservative leverage matters. The lower your starting loan to value ratio, the more room you have if Bitcoin becomes volatile. Volatility isn't the problem, over leveraging is. If the borrowed capital was invested in income producing assets, those dividends may help cover interest costs, but income alone shouldn't be your only safety plan. The goal of this strategy isn't maximum leverage, it's maintaining long-term exposure to Bitcoin while building cash flow from other assets. Bitcoin becomes the growth engine, income investments provide stability. Borrowing against Bitcoin can be a powerful tool, but only if it's used carefully. Leverage should increase flexibility, not create fragility. In the next video, I'll break down how much Bitcoin you would actually need to generate monthly income with.